We had a relatively quiet day on Wall Street for once. The S&P 500 did manage to close higher, but not by much, and it was partially due to some extra strength in the mega cap tech-oriented areas, with interest rates falling just a little bit here today before tomorrow's important inflation reading. We did find that all four of our major market indices hit a new yearly low at one point during today's session, and they all closed with oversold cluster signals, so we're far from out of the woods at this point. We'll also talk about in tonight's video some areas that have recently fallen out of favor, including real estate and gold. And then in our trade application example, I wanted to tap into a consumer staples stock that is in a nice trend of higher highs and higher lows. So with that, let's go ahead and get started. Welcome to the Market Outlook video presented by MarketScholars.com. I'm your host, Brandon Van Zee. It's May 10th, 2022. First of all, if you're new, welcome aboard. Remember to go over to YouTube, click subscribe on our channel, then go down below into our description area and make sure you're signed up for our email distribution list. That way you can be privy to whenever we post these videos, and you'll also find at the bottom of those emails any stocks that are giving you overbought and oversold cluster signals. We'll actually be talking about clusters quite a bit in tonight's broadcast as a result of the indexes having a lot of clusters. Also, we're heavy users of Twitter. If you're not doing so already, I would encourage you to follow me at Brandon Van Zee. Also, big congrats to David over the weekend for eclipsing the 10,000 follower mark there. That's a big milestone on Twitter. So if you're not doing so, make sure you're following David as well. He has some excellent commentary, especially during these more volatile markets that we've been experiencing here lately. And then last but not least, we do have a presence over on Facebook. Feel free to join our group at that web address you see in the logo in front of you. All right, let's go ahead and jump into the trade activity for the day. There wasn't as much activity today as what we've been used to, in recent sessions. It was a little bit of a quieter day here today. A quick glance here at the heat map shows that it was a pretty even split. The good news is it seems like the bigger market cap companies tended to be on the positive side of the coin here today. A couple of exceptions to that, naturally, like Amazon. Actually, Amazon did end up closing just barely higher by 0.06%. So I guess they did add a tiny skosh of bullishness to the market today. But it was good to see Apple. It was good to see Microsoft, Nvidia, Alphabet, Tesla. Those big players all assisted the market here today. Where we do have a lot of red is kind of in the lower right-hand corner here. A lot of financials were in the red. We had a lot of industrials in the red. Real estate has been quite ugly, which has been interesting. We'll take a look at the chart when we do our normal sector evaluation later on. But number of real estate stocks have really fallen out of favor here recently. In fact, some of them are starting to pop up on my radar from a dividend growth investing perspective. And then you also had a lot of the consumer staples kind of take a step back here earlier today. So all in all, about a split difference here today, but because of the mega cap strength, it was a more positive day for the market than what we had been witnessing in recent sessions. Let's take a look at our 4-grid now. And as you can see, the S&P 500 did manage a gain today, but it was only 0.25%. And that really doesn't tell the full story either. Those of you that watched the market here earlier today might have noticed that we were actually gapping higher here to start the day, and it looked like we were going to be off to the races for a brief amount of time, and then eventually the sellers did kind of step into the market once again and dampen that enthusiasm. So it's good to get a win. On the other hand, this dark candle that you see here on the S&P 500 effectively means that we opened high and we closed low. So although we did manage a gain from yesterday's closing price, we closed lower than our open this morning after that minor gap higher. And so we're still kind of awaiting a major washout type of a day, where you have, the old rug pull, or some of you have heard me refer to it as, kind of like a toilet flush of sorts, where you basically trap a lot of folks by stopping them out and making it look as though it was a kind of a capitulation type of a day where the markets are just deteriorating rapidly, and then have a very robust rebound into the close of the day. So you'll hear us discussing things like long lower shadows if and when that does occur, and we still haven't really witnessed that yet. So that's kind of the scary part. This decline that we've all been experiencing has kind of felt like, death by 1,000 paper cuts, as opposed to just a complete wipeout type of a scenario. And maybe that's still on the horizon, right? Some of the commentary around the VIX as an example. I talked about this last week as well, but if you didn't catch it, just a reminder that the VIX right now at about 33 is still lower than where the VIX was back in February. On February 24th, it got all the way up to 37. Today it's at 33. Yet when you look at the S&P 500 chart, where we're at right now versus back here on the 24th of February right here, notice that price is now lower than where we were back then, even though the VIX is also lower. And so that's a little bit nerve-wracking, because it kind of gives you the impression that the VIX just hasn't had that one last spike in order to kind of set the low in the near term. And I do think we will end up having some sort of a rally here. In the back of my mind, what I'm thinking, whether this happens or not, but what I'm thinking is that we'll see a pretty substantial rally at some point in the next week and a half. But my fear is what I mentioned to you guys last week, which is if we get a rally in the markets back up towards that falling 30-day moving average, my expectation right now, without seeing anything else, is that we will end up failing at those levels, and we will still have more hard work in front of us as the months roll on. In other words, I expect a short-term bounce from these oversold conditions, but I'm not expecting that short-term bounce to be trend changing. We are still going to be in an intermediate downtrend. How far up we go is anybody's guess. But I'm hoping that on the S&P 500, maybe we can kind of tag around, let's call it the 42.85 area. That would be, I think, a nice, healthy bounce from where we're at right now. That would kind of put us in line with those three bullish candles, the tops of those three bullish candles right there. So if we could get up there, I'd be pretty happy about that. Whether we actually have enough oomph, enough of an adrenaline push up to that direction remains to be seen. But at least we do have, the fertile grounds for that type of a possibility now that we are starting to see these oversold cluster signals showing up. Notice these two dots down here at the bottom. In fact, let me right-click on the S&P 500 chart and then come over here to maximize the sell, so that way you guys can see this a little bit more clearly. These oversold cluster signals show up when you have the green, the blue, and the red market forecast lines in the lower reversal zone below 20 on the same day or the same candle. So for the last 2 days, meaning yesterday being Monday and today being Tuesday, we have had those oversold cluster signals. And notice that we haven't had those signals anywhere else on this 3-month chart. We did have an overbought cluster signal, so for any of you that might have sold the market on this candle back here, congratulations. You probably sidestepped at least some disaster. Obviously, that's not going to work every time, but in this particular case, it worked out pretty nicely there for you as the market only went up a couple more days and then started this rollover again. But in terms of these green dots for the oversold clusters, we don't see any more other than the last 2 days. Now, if we go back far enough, let's start going back 6 months and see if we recognize any. We did have one back here on January 21st. This is the last time, by the way, when you heard me use that language of a toilet flush, because this is that long lower shadow I was referencing at that time back here on January 24th. And it did take a little bit of time. You know, we had 3 days in a row sideways where it didn't really do much of anything. But then we had a really robust 4-day rally where we closed near the highs of the session on all 4 of those days, and we settled in just under that falling moving average. And that's my fear once again, is that if we get one of these days coming up where we have this long lower shadow where it sells everybody out, everybody throws their hands in the air and gets stopped out, and then the market makers whip the market back higher, my fear is similar to what it would have been back here, which is I just don't think we have enough strength to get back up and actually change the trend here. I would venture to guess that we'll ultimately fail underneath this falling moving average yet again. But you can see that that is a fairly rare signal. What we've seen in the last 2 days, we had only seen one other time in the last 6 months, and that was a reasonably decent time to take speculative bullish trades for the next week or two, as the market did catch a bit of a bounce there, even though it was not trend changing. If we go back a little bit further and do a 1-year daily here, let's see if there were any others along the way, and that was it. There were no more. So in the last entire rolling 1-year time period, the only other oversold cluster signal using daily candle chart before this last 48 hours was what we experienced here at the end of January. Now, beyond this, some of you saw me tweeting out, I think it was yesterday, and I didn't double check to see if this is still the case, but on Twitter yesterday I was posting about how the S&P 500 also produced an oversold cluster signal on the weekly candle chart. So what we're looking at right now is the daily candle chart. So when we're looking at a year, we're looking at about 252 trading days here right in front of us. But if I were to change this now and go to a 5-year weekly candle chart instead of daily candles, notice that we do still, at this moment in time, have an oversold cluster signal on S&P 500 index using a weekly candle chart. And on this 5-year chart, the only other time where you see that green dot exist is back here during the Christmas swoon of 2018. And you can imagine that if you could go back in history and start taking bullish trades at different areas on the chart, some of you, of course, would naturally want to go back here to the coronavirus wipeout to start establishing long-term positions. But another natural point that your eye would drift towards is this point right back over here, exactly when you had that oversold weekly cluster show up on the S&P 500. So this week, and again, I need to stress, just like I did on Twitter yesterday, because yesterday was Monday and today is only Tuesday, if we do have a big rally throughout the rest of this week, this current dot could disappear. So if the market does rally at the end of the week, this oversold condition can go away, right? Because it's still in progress. All these other instances would already be locked in. So it is important to recognize that as well. But if we do end with an oversold cluster signal here on the S&P 500 this week, the only other time that's happened in the last 5 years is back here, which would have been a pretty darn good time to be looking at kind of a counter trend type of a move there. And then if you take it a step further and go back on a 10-year weekly candle chart, just to kind of reiterate the rarity of this particular signal, there was not a single instance of the oversold weekly candles in the 5 years prior to that. So in other words, on this 10-year chart, which takes us back an entire decade or 520 weeks, there was only one signal in that entire time period before this moment in time where we had an oversold cluster signal, and that happened at a time that was a reasonable, blip to add to longer term positions. But again, going back to what my fears are, is that you can see that back here in 2018, we weren't all that far below the moving average. And so it was a little bit easier for us to actually make a trend-changing moment off of that oversold condition. My fear is that we are so far below this moving average right now in real time that just to get back to the moving average is going to take a monumental effort. And it can do it, but I would personally be surprised if all of a sudden we were taking out these prior all-time highs, let's say by the end of this summer. Whereas back here, you were able to do that. At the end of December, you had this oversold cluster signal in 2018, and by this moment in time right here in April of the following year, so basically 5 months later, you were hitting new all-time highs in the stock market. I would personally be surprised if that plays out that way this time around. But it doesn't mean that we can't have some very good bullishness here in the immediate short term. So that's why I'm saying here in the next couple of weeks, if we do get a little spark that lights a rally, it could be pretty violent to the upside, judging by what we've seen in situations like this in the past. And so if that does happen, then you can position yourself accordingly. Some of you might have felt like you've got a little bit too much long exposure right now, and if that's the case, you might look to, lighten up your long exposure on any sort of rally in the short term. Others may be patiently waiting to reload the gun, so to speak, when it comes to bearish trades. And if we get a big rip higher here in the next couple of weeks, and then it looks like the rally is going to stall out, then that's when you're going to reapply those bearish trades again. Of course, if you need assistance with that, David and I do a lot of that in our premium classes here at Market Scholars. I know for my own instance, we had a short sell on MGM, the Vegas casino company, last Wednesday, and we were able to shut that down yesterday at max gain and make money when the stock market fell. And I don't do nearly as much of that as David does, just because of the way that we divided up our classes. But David does a ton of bearish trades. In fact, he's got short futures contracts that he's made nice money off of as a hedge. He's also, if I'm not mistaken, had taken a bearish trade in Coinbase, which I noticed after hours tonight is getting pulverized in the after hours session, just like so many growth stocks have here recently. And so David's done a fantastic job with some of his bearish trades on those growth stocks that have just torpedoed lower here recently. So again, if you're not engaged with your premium education, we would encourage you to join the classes. And if you're not currently one of our premium subscribers, then we would encourage you to investigate that if you need some assistance on that side of the coin or for anything else, right? Obviously, with markets being as ugly as they have been here recently, it also opens up the opportunity for long-term investments. In fact, I taught my dividend growth investing class today, and we bought a stock that we haven't had the ability to buy for basically 3 or 4 years. In other words, the stock finally fell out of favor enough that it gave other people who might have missed the opportunity a few years ago another chance at that particular high-quality company, going forward. So obviously, we enjoyed doing these videos here for free on YouTube, but we don't make any money off of doing that. And so we always have to also remind you of our premium services where we actually do make money, and it incentivizes us to kind of have this freemium model, as they call it, where we can do some of this stuff like this YouTube video for free, but the serious business that we get into is in our premium trading rooms. Anyway, let's get back on track here with the typical review, and let me go back over here with the 6-month daily. One thing I wanted to point out that stood out to me when I was looking at this 4-grid here is that we have these pink tags showing up on all 4 charts. I don't remember the last time that happened. It likely would have been during the coronavirus wipeout period, but that was a couple of years ago, so it doesn't stick with me right off the top of my head. But I will just point out to you that we do have yearly lows across the board on all four of our charts right now. Remember when I was with you last time, it must have been Thursday, we were talking about how the NASDAQ Composite and the Russell 2000 were down there. So in other words, we now have the S&P 500 and the Dow Jones Industrial Average basically joining those other two indices, hitting new 52-week lows here today. So although the S&P 500 closed higher today, at one point during the day it pressed lower far enough where you now have that new low set on the S&P 500 just a hair below 4,000, even though we closed just a hair above 4,000 at this moment in time. So second day in a row for clusters on the S&P 500, and we were up 0.25% at the end of the day. Naturally, we continue to have that strongly bearish posture on the market forecast intermediate line. Again, the line that we use there is this green line down below to set our posture from an intermediate trading perspective. So falling 30-day moving average, price below it, and continue to have a strongly bearish posture, although sometimes extremely bad news can turn into good news, and that's kind of where we're at right now with these oversold cluster signals. We're just waiting for one kind of last whoosh and wipeout to really scare people and startle people to the downside, maybe get that VIX a lot higher, and then maybe that will kind of set the table for a wicked reversal to the upside. But again, be cautious as we approach that falling 30-day moving average if that does come to fruition. On the Dow, you can see that it has its first oversold cluster signal here today. And so unlike the S&P 500 and the other indices, this is the first one. So remember that the Dow tends to hold up better when markets are weaker. It doesn't mean that the Dow just magically gets an opportunity to go up when the markets are weak. It just basically means that you have big blue chip companies like Coca-Cola and Procter & Gamble and those types of companies in the Dow. It tends not to go down as violently as the others. Now, the flip side of that is it usually doesn't go up as fast as the others when the markets are bullish either. So there is the other side of the coin there. But I guess that's just one way to kind of reiterate that notion for your own education. These other indices have already been violently sold off where they've already had clusters before today. The Dow is just kind of playing catch up because it kind of lags them to the downside because of its blue chip nature. So the Dow was down 0.26% here today. It did hit a new one-year low along the way, just like the others, and it produced its first oversold cluster signal. Naturally, it still has price below a falling 30-day moving average and continues to have a strongly bearish posture. That's the case with all these, right? That's the type of market we're in right now. Sometimes you have a market where, one index might be looking a little bit different than the others, but when you're in a market like this, they always say in a falling market correlations go to 1. In other words, all stocks are falling. And so that's what you're kind of witnessing right here. So all four of these indices have price below their falling moving averages. All four of them have strongly bearish postures right now, and all four of them currently have oversold cluster signals, at least on the daily candle charts. On the two bottom charts here, we did have the NASDAQ snap back the most today. Now remember, it had been doing the worst. And so when you have a situation where something has been beaten down so violently, it is usually the one that can get back or snap back the quickest as well. And so despite the NASDAQ leading today up nearly 1%, it still has the lowest intermediate line reading of all four of these indices. It's still only at 9.92. So although it went up nearly 1% today, which is pretty decent for an index, it is still dramatically buried in that lower reversal zone right now. So it's got a lot of work to do. We'll talk about it a little bit later, but one of the reasons that the NASDAQ was catching a little bit of a bid here today perhaps is because we finally had a little bit of relief with Treasury yields. We did have Treasury yields close just under 3% today, whereas it had been spending recent sessions above 3%. So that kind of helped the NASDAQ, which has been struggling or grappling with that here more recently. But with the NASDAQ, it's been 3 days in a row, 3 trading days in a row, so that extends back to last Friday as well. Friday, Monday, Tuesday, we have had 3 oversold cluster signals in a row there. Now, unlike the S&P 500, notice that when you look at the 3-month chart on the NASDAQ, because it had been out of favor much more often, you've had a few more of those cluster signals show up. This first one back here on March 14th actually worked pretty nicely. If you did a counter trend bullish trade right there, you got a good 2 or 3 weeks out of that. This next one over here on April 27th didn't really pan out all that well. Maybe you got a little bit of boost where you had that 3-day rally right there, but then it just kind of fell right back into more oversold conditions. And that's kind of the same way that we're looking at the Russell 2000 over here as well. It also has 3 days in a row of clusters. It also had a cluster over here on April 27th that didn't really pan out all that well unless you got lucky enough to, get out right at the top of that candle right there, because that was nicely higher than that candle, but it's not, as nice of a reversal as what you saw on the NASDAQ back here in March. That's the kind of move I think most people would like to see if they're going to be counter trend and play the reversal of an oversold move like that. By the way, there was another oversold cluster on the NASDAQ over here on February 23rd, and you did have 3 days in a row of upside after that, but again, it didn't really have a big swing higher, and then it ended up failing at the 30-day moving average there in that case. So with the Russell 2000, it was basically flat today. It was technically down 0.02%. So we had a couple of indices, the Dow and the Russell, down just slightly today. We had a couple of them, the S&P 500 and the NASDAQ, that were up today. And I think the big reason behind that is what I had briefly showed you before on the heat map, where you've got these bigger squares that are tech-oriented, that are pulling their weight a little bit heavier than others, right? The NASDAQ, of course, is loaded with tech stocks. The S&P 500 is driven by tech stocks these days because it just happens to be the case that the tech stocks have the biggest market caps. So when you have a heat map that looks like this, it ends up shaking out from an index level like this because, a lot of your, smaller banks and oil companies and things like that are going to end up being in the Russell 2000, and then in the Dow Jones you're going to have your big consumer staples companies and things like that. So when tech is an outperformer, as it was today, especially mega cap tech, that's where you're going to find the S&P 500 and the NASDAQ composite holding up there a little bit better. Let's step away and take a look at the internet here briefly. I always like to get a chance to say thank you to those of you that help support this presentation. As I mentioned before, we don't make any money doing these, and they do take up about 3 hours of our day. And so we always have to ask ourselves a critical question. Is the 3 hours that we're going to take out of our day worth it to us or not? And from a monetary perspective, the answer to that is no. From a goodwill perspective of whether we're helping you guys with these free videos or not, that is, debatable, I suppose. And the way that you guys will let us know as to whether these are helpful videos for you and you like to hear us and check in with us on a daily basis like this is by telling us through the likes on Twitter. And as I always tell you, as long as we're up and over 100 likes, I'll be happy to do a full-length video there for you. If we're under 100 likes, then I would plan on doing just a shortened 15-minute kind of quick hitter video only on the indices themselves and with no trade application example. You guys haven't failed me yet this year. We've cut it close a number of times, just like we did this last time where we just got to 102. So we just got over the triple digits there by 2 or 3 likes. So you've gotten quite close to it a few times, but to my recollection, I don't think there's been a single time that I've done these videos on Tuesdays and Thursdays where you guys haven't gotten me to the triple digits. So keep up the great work there. I do appreciate that. And as most of you who do that regularly will know, it's not a big effort, right? Without a doubt, David and I, of course, are putting in a much bigger effort to produce these videos. You guys get the easy job of just taking 5 seconds out of your day to click like. And we do appreciate those of you that do that consistently. So please keep that up, and we'll do our best to keep on producing these videos for you as well. While we're over here, I also wanted to take a look at the sector selector tool. Now remember, we update this on Friday evenings, so it would not include any movements we've seen with the sectors here in the first 2 days of this week. Nonetheless, can give us a general sense as to what's happening from a sector rotation perspective. And once again, I know I sound like a broken record, but that's because energy has been number one for the entire last 3 months of this rolling graphic here, but even in several of the weeks or months prior to what you see here, which the furthest back date is February 11th. So energy has been the star of the show in 2022. Some of you might have noticed that yesterday was a pretty ugly day for energy stocks. So what we had been noticing earlier in the year is that on a lot of the days where the market was really getting hit to the downside, energy stocks held up and in many of the cases actually finished in the green. That did not happen yesterday. Oil stocks were down significantly yesterday right alongside the rest of the market. Some of you might have saw my tweet where I had a picture of Kareem Abdul-Jabbar, or Lou Alcindor, as he used to be known as, with his teammates from UCLA back in the 70s, I believe. And I get a kick out of that picture that I posted on Twitter because he just stands out head and shoulders above everybody else. I mean, he was probably a 7-footer, and all the rest might have been like, 6'3" guys. And so I said yesterday the only sector that was actually doing well was consumer staples. So, they kind of stood out like Lou Alcindor there back with his teammates. But usually, if you were to kind of extend that analogy a bit further and not just talk about it yesterday, if you were to say, well, who's the Lou Alcindor or Kareem Abdul-Jabbar in the whole calendar year of 2022? And there, without a doubt, it is still energy. Energy is head and shoulders above the competition from a performance perspective on a year-to-date basis. But it is true that eventually what goes up must come down, right? We're all witnessing that in real time with the tech stocks right now. And at some point in the future, those oil companies will start dropping as well. And maybe yesterday was a little bit of a hint that, perhaps there are some cracks in the sidewalk in the energy patch here a little bit more recently. So we'll keep you posted if we do see movements from energy. But up until this week, we still had energy in the top slot there. Consumer staples stayed at number 2. And utilities stayed at number 3. In fact, materials stayed at number 4. So week over week, we actually had the exact same rankings on all 4 of those top performers there. And then on the downside, again, this is a market that really dislikes consumer discretionary, information technology, and communication services. Now, remember, we use this graphic to help us make decisions in my Monday top-down trend trading class. And as I was explaining to the students there yesterday morning, this is pretty much the exact opposite of what you want to see in a strongly bullish market. You'd prefer to see these defensives and these commodity-based sectors on the bottom, and you'd prefer to see these compounding growth areas like consumer discretionary, technology, communication services up at the top. So we have the exact opposite look that what we would typically want if we wanted to be in a robust market environment right now. This is not a great time to be a trend trader. We've talked about that many times in my factor-based swing trading class, and I'm sure we'll talk about it again tomorrow morning when we review the momentum factor, which is basically a proxy for trend trading. And this has not been a kind year for people who've been chasing price. They've been burned more times than not. It has been a year where folks that have bought stocks that were out of favor from the oil and gas world or utilities or consumer staples or what have you in previous months or years to benefit to watch what was once not hot rise to be hot, and the opposite has happened with those at the bottom. The superstar stocks in recent years have been the discretionary technology and communications areas, and of course those are the ones that have rolled over so violently here this year. All right, let's go ahead and get back on track with some more analysis over on Thinkorswim. And let's do our 12 grid analysis starting with chart 5A. This is our asset class 12 grid. And a reminder that the background colors of the charts will be pink if the intermediate posture of those securities is bearish, and the charts will be green if the intermediate posture of those securities is bullish. And so as you can see, we still just have the 2 corners at the bottom of this first 12 grid that are sitting in that bullish territory. And in the case of the US dollar, which we actually looked at in one of my classes here recently, it was up again today. Surprise, surprise, right? It seems like more times than not, the US dollar has been strengthening in a uncomfortable market like we found ourselves in here more recently. As I mentioned to you guys last week, it's kind of like the best house in a bad neighborhood. In other words, all currencies are kind of getting inflated. Central banks are printing money, or at least they had been in recent years. But when we get into a chaotic market environment, it is usually the US dollar that kind of acts as a little bit of a safe haven compared to currencies of, let's say, emerging markets or something along those lines. So the dollar versus a basket of other currencies continues to show us a strongly bullish posture. It was up yet again today, and you're basically sitting at multi-month, in fact, probably close to multi-year highs on the dollar. The Treasury yield, as I alluded to earlier in the presentation, looks a little bit different because we've actually had 2 days of selling with yields, right? And that means the opposite for bond prices. Bonds have gone up the last couple of days. Their yields have gone down. That's a little bit different than the dollar. The dollar has continued to have strength. This is the 4th day in a row to the upside for the dollar, but we've actually seen the 10-year U.S. Treasury yield pull back 2 days in a row. And as I alluded to earlier, you can see up here with your own eyes that if you move that decimal point over to the left one on TNX, that is effectively what your 10-year Treasury yield is at this moment in time. So we are back below a 3% yield, just barely. We had been as high as like 3.15% yield thereabouts yesterday. So we've given back a healthy amount there, but unfortunately, you can see that we've been in such a robust uptrend that even a 2-day pullback in yields is not enough to take away the strongly bullish posture here. In fact, the intermediate line is at 90, and although it's falling right now, it would have to give back quite a bit more to fall below 80, which is effectively what would need to occur before we saw the background color change to light pink. So you might have to see the 10-year Treasury yield actually fall below its 30-day moving average before that's going to happen. So anyway, it is true that we had a little bit of a pullback in yields the last couple days. That might have helped support some of those NASDAQ stocks, but this is hardly a broken trend at this point. So there's still a little bit of work to do. If we're going to see the NASDAQ skyrocket higher, you probably are going to need to see interest rates or yields break down fairly violently at the same time. Whether that's in the cards or not is anybody's guess. Obviously, we know that Jay Powell and company want interest rates to go higher through their interest rate policy, but perhaps the market's getting ahead of itself in that regard as well. So anyway, those are the only 2 bullish charts. All the rest are bearish. Now, recently bearish, which is worth pointing out here, is oil. I mentioned that yesterday the oil stocks got just destroyed, and part of the reason is because oil prices were down significantly, and today didn't really help that cause. Oil prices were down another 3% or thereabouts today, and look at how quickly the chart has changed. It was just 3 days ago we were talking about how oil prices were up here fairly close to 3-month highs, and after just 2 days of selling, all of a sudden oil is below its 30-day moving average. That moving average is still rising. That's why the moving average is colored yellow right here. But if we spend enough time below that moving average, even that will change. In fact, yesterday, briefly, it was trending a little bit lower. So, do we want to make too much of this? Probably not, because more times than not, in the last, let's call it 5 months or so, when oil prices have pulled back, it's been a time to buy oil, not sell it. And so you kind of want to give it the benefit of the doubt if it's been doing that repeatedly in recent months, and that has been the case. But at the same time, we have to all recognize, again, trends will end at some point, and maybe oil just got a little bit too far above its skis. And so we have had a pretty violent 2-day move lower there on oil. And maybe that will help with the inflationary concerns as well. If we can start seeing commodities rolling over, then maybe some of those concerns about inflation will kind of move to the sidelines as well, and that could help support other types of companies in the stock market that have been beaten up here more recently. Gold actually looks pretty terrible, which is a bit shocking, right? Oil is, we want to give it the benefit of the doubt because it hasn't broken any significant support levels yet. Gold is a little bit of a different story. Notice the color of the moving average on gold has been consistently red since basically, mid to end of April. So we've been dealing with this type of behavior on gold for the last 3 weeks or thereabouts, somewhere in that general vicinity. So it's a little bit of a newer phenomenon on oil, but it's more of the same on gold. And again, I don't think a lot of people are talking about that. We have recognized that, I can tell you, in my top-down trend trading class, because we do have some mining companies in that particular portfolio, and we've noticed that they have fallen out of favor in a hurry, right? Sometimes you have stocks that can move very, very quickly, and unfortunately, the highly cyclical mining stocks fit the bill there, and they have rotated out of favor very quickly, much to our chagrin in that particular class. But I don't really get the sense that a lot of people on CNBC or what have you are talking about how gold is actually rolling over right now. It's so bad that, as you can see, you have an oversold cluster signal here on GLD. So it was down 0.84% today. You have a strongly bearish posture as opposed to a weekly bearish posture that you have with oil. And you have price easily below a falling 30-day moving average. Price is very close to a 3-month low on gold, right? A lot of times you're thinking we're in a highly inflationary environment. Surely gold is doing well. Nope. Right now, we're actually basically sitting at 3-month lows on gold. It's so bad that you have oversold cluster signals. And I don't think a lot of people would guess that without looking at a chart if you just ask them point blank in the street right now. All these other charts up above are pretty ugly, right? They're all dark pink, meaning strongly bearish, and they're all struggling in this environment, especially Bitcoin. Notice Bitcoin just keeps on plunging here, where it's the boy who cried wolf, too many times with the oversold cluster signals kind of joining what we've already been experiencing in the bond market over here. Bitcoin has really, really struggled here in the last couple of weeks or so and has lost some key areas. Remember, it wasn't so long ago we were talking about Bitcoin at 40,000, and it seems like in just a straight line we've gone from 40,000 down to 30,000 on Bitcoin. So again, we've tried to assist you with that concept in the last several months because some people previous had said that Bitcoin was a tool for capital preservation, or digital gold, or a safe haven asset, or people will try to sell it to you a million different ways. But the truth of the matter is Bitcoin is a risk asset. It is a speculative asset, and you can make money off of it. So it's not me vilifying it. It is just me letting you know that Bitcoin obviously has done terribly during this market environment where the stock market has gotten annihilated and inflation has gone up dramatically. And previous to this moment in time, there would have been some people that would have told you that would not have been the case if we had been in this market environment. So we can now all see clearly with our own eyes that Bitcoin is a highly speculative asset. And it can certainly have some great moves when market environment is different and people are willing to take on risk. But right now, this is a risk-off market environment, and Bitcoin has paid the price as a result of that, just like a lot of tech stocks and growth companies have. Up at the top rung, we do see that the foreign stock markets are struggling just like the U.S. markets are. We've had 3 days in a row of oversold cluster signals there on both EEM, which is the emerging markets, and also the developed foreign stocks like those in Europe. So it's not like it's just us here in the United States that are struggling. Folks in stocks all across the globe are struggling at this moment in time. Let's now take a look at our sector 12 grid. This will be chart 5C. And as we pull this up, boy, what a bleak picture this is. Not a single green chart on the board. We do have one white one, which is pretty rare, and that is utilities. And that only happens in a rare situation where the intermediate posture effectively is just going sideways. But you could basically call that sideways to down, because you can see here that the moving average itself is going lower at this point. Even energy, remember, energy had been the stalwart for so long, and just a few days ago it had a strongly bullish posture. But because of this violent move lower yesterday in particular, today it was actually up. Despite oil prices being down, oil stocks were up. But yesterday was such a beatdown. Look at that candle. That is the worst candle on the board of this 3-month period for XLE. It was demolished yesterday. It was down like 7 or 8%, something like that. And remember, XLE is driven mostly by Chevron and Exxon. Usually those two don't move all that violently, so that really puts it into context even further. So yesterday was a truly terrible day for XLE, and it was enough to actually pull the intermediate line out of the upper reversal zone above 80 and is now finding itself down there at 74 and falling. So could it correct course and get back above its moving average and back to a bullish posture with some big moves up in price? Of course. We're not all that far away from it. If you look at all of these charts, this is still the one that has even any inkling of an uptrend that exists, right? Pretty much all the rest of the charts show more downward price pressure. But energy kind of has been one of those that continues to set higher highs and higher lows along the way. We're just happen to be in one of those pullback modes right now. With all of these charts that you see here, energy actually held in pretty well today. In fact, it looks like the only other sector that was better than it today was technology. Again, technology benefiting from a little bit of a pullback in rates there today. And you can see that technology was up 1.5% there. But when you look at technology and then you look at energy and you look at where we've been in the last 3 months, technology is down 14% in 3 months. Energy is still up 12% despite yesterday's massacre. So we're talking about two different ball games there with those two particular sectors. Unfortunately, most of the other sectors were down today. We did have a minor win there with communications as well. They were up 0.45%, but otherwise all the rest of the sectors, actually, I take that back. Sorry. I didn't see this one in the lower left-hand corner. Healthcare was up today as well. Healthcare might have got a little bit of a benefit. Some of you might have heard that Biohaven is being bought out by Pfizer, and so that might have had some speculative activity involved there as well. But the point that I'm trying to make, if I could get it out, is that the S&P 500 was up today, yet most sectors within the S&P 500 were actually down, right? If you were to count the sectors that were down today, financials were down. So that's 1. 2 is discretionary. 3 is industrials. 4 is materials. 5 is staples. 6 is utilities. And 7 is real estate. So it's a little bit of an oddball type of a day where the market itself was up, but 7 out of the 11 sectors were actually down. And part of the reason that exists, or that possibility can occur, is because technology is such an influential sector on the S&P 500 due to it being a market cap weighted index. And so kind of pulled a little bit of extra credit there for the markets here today. So, it was a pretty ugly day. One thing I did want to point out as well, I kind of mentioned this before when we were looking at the heat map, but look at how quickly real estate has fallen out of favor. I mean, this is one of the more violent moves I've ever seen in the REITs. REITs traditionally don't move around aggressively. This has been like taking the elevator down in the REITs here in just the last 2 weeks. Just a couple of weeks ago, the REITs actually look like one of the better sectors out there. They've gone from looking like one of the better sectors to one of the worst sectors in just the snap of the fingers. And so don't be surprised at all if next Tuesday, when we get back in class together from the dividend growth investing class, if we start looking at some REITs again, because many of them have fallen violently in just a couple of weeks, and some of them have fallen into very attractive territories on the dividend stair-step chart. So if things hold between now and next Tuesday, we might very well be scooping up some REITs in my DGI class to see, if maybe some babies have been thrown out with the bathwater there. You can see that the REITs right now do have an oversold cluster signal, as do healthcare, as do industrials, as do discretionary, as do communications, and as do financials, along with the market at large. But again, what makes the REITs a little bit different in my mind there is that they had looked quite good just a few weeks ago, somewhat closer to what we saw with healthcare as well. But those others that I rattled off, they've kind of been in downtrends for a while. So anyway, quite the move there we've seen in real estate investment trusts. All right, let's go ahead and get into our trade application example for the day. And I wanted to concentrate on the consumer staples space. As you can see here, the consumer staples have largely just tracked sideways in the last week when the markets themselves have kind of plunged lower. If you were to look at the S&P 500 up here and look at the last 5 days worth of trading, we've gone down fairly violently. Whereas when you look at the last 5 days of trading on the staples, we've gone largely sideways. The other thing I would point out, and we talked about this a little bit yesterday in my top-down trend trading class, is this XLP, which is a market cap weighted staples ETF, looks a little bit worse than the equal weighted version. If I were to come over here and look at chart 1G, the equal weighted sectors 12 grid, and look at consumer staples down below here, you can see that consumer staples actually look quite a bit better on an equal weighted basis. So some of those smaller and mid cap types of consumer staples are maybe holding up their end of the bargain a little bit better than maybe some of those mega cap staples companies are right now. I did see one mega cap staples company, Altria as an example, got hit pretty hard today. So it's going to play a little bit more of a role in XLP than it does here with RHS that tries to equalize all consumer staples. So consumer staples on an equal weighted basis still look reasonably good. I would say that they look the second best just after the energy stocks at this moment in time, which is part of the reason why the sector selector shows energy first and consumer staples second. Remember that particular sector selector tool does use an equal weighted approach, so it'd be a little bit more akin to this chart 1G here as opposed to the 5C chart that we were looking at a moment ago with a market cap weighted. But point being, consumer staples have held up reasonably well. And so I wanted to find a stock that has been kind of holding up its end of the bargain in that particular area. So let me pull up chart 3A here, and I'm going to pull up ticker symbol TAP. It's always an easy one to remember. For those of you that are beer drinkers out there, this is Molson Coors, of course, the company behind the Silver Bullet cans here in the United States. But they do have brands all across the globe as well. And so this is a company that, as you can see, is catching a nice little bounce here recently. And we actually closed basically, it might have been the high of the day. It was. We closed, actually we were 2 cents off of the high of the day. The high of the day was 54.86 and we closed at 54.84. So remember, I do these trades while the market is open and then send out the telegram notice to all of you who are premium members of Market Scholars, so that way you can kind of consider these trades for your own paper money accounts before everybody else that watches the video for free later that night. So it gives you a slight advantage there for being a premium client of ours, in addition to, of course, all of the other advantages that we give you. But the point being, when the stock basically closes at the high of the session, that's a good thing for any of the trades that were done earlier in the day. So we are making a little bit of money on this one. But the way that I set it up was just as a bullish swing trade, just simply using the stock itself. So this is not an options trade in this particular case. Some of the features that I liked about it and why it caught my eye today is because it was actually up today while the consumer staples kind of struggled. If I'm not mistaken, they closed lower. Yeah, they did by 0.69% if you're to look at XLP. So the consumer staples struggled today, yet this particular stock within the staples did quite well. it was an obvious outperformer here today. And of course, not only is it outperforming its sector today, but it outperformed the market at large today that was just barely up, the S&P 500 only being up 0.25% or whatever it was. And of course, as you look back over the last 3 months of this chart, this S&P 500 dotted line down below is way below Molson Coors price candles up above. Another way of saying that is this is a market-beating security at this moment in time. It has relative strength. In fact, this is one of the rare stocks that you'll find out there that if you pulled up chart 3A, where we've got all these different time period performance labels, remember those labels will be red if they are negative. So over the last year, it is negative in the red. It's down by 7% year over year, but all of these other labels here are green. So anything from 9 months to year to date, we have positive returns on this kind of sleepy beer company, right? Not the most exciting company on planet Earth, but is the type of company that folks might drift towards in tough markets. Folks that enjoy drinking an adult beverage probably are going to continue to buy their, 6-pack of Coors or whatever on the weekends, whether they are in a good economy, a bad economy, or otherwise. In fact, some people joke that when we're in a bad economy, people drink more. Whether that's true or not, I don't know. But what I can say is that the chart is firming up pretty nicely here. And you can see that with today's boost, the moving average color is now green once again because we spend a little bit of time below that moving average, but with the kick higher there today, we're back above that rising moving average, and this is forming a series of higher highs and higher lows over the last 3 months of this chart. You can see you got a low here, you got a higher low here, and you have yet another higher low right here. You've got a high here, another higher high there, another higher high there, and another higher high there. So this is actually one of the rare trending stocks in this very ugly market that we've found ourselves in here more recently. And so what I chose to do with today's trade is just a simple swing trade where we are shooting for this area up above here where you can see where I've got my limit order established, which means that as long as it can get up in this general vicinity of where it hit its high before, we would be able to get out with our max gain. On the other hand, if it rolls over from here for any reason and comes down here closer to like $52, then we would end up being stopped out. So in other words, if this ended up being a higher low in this ongoing trend higher, then our trade should work out, assuming that it continues that trend, right? And they always say a trend is your friend until the end. Maybe this is the end, but if it's not, then hopefully this trend will continue to be friendly for us. And if it does, and it establishes yet another higher high, we will be taking our profits before then. You can also see that the green line is rising, so even from an intermediate perspective, this would be considered a bullish posture. And you do have a bit of a bullish near-term divergence signal here as well. So if you look down below here on this near-term blue line, that's a little bit heavier weighting here on this chart because this is our swing trading chart. So this blue line is our near-term line, and you have this low on the near-term line back here on April 22nd. And then it went up, it pulled back again, it established a new low right here on May 4th. Notice that that low is higher than that low. Yet when you look at the price candles up above, notice that the first low is with this candle up here that I'm circling, and the second low is with this candle right here that I'm circling. So what we're seeing is price went down, right? Price went slightly lower from right here down to right here. At the same time, we saw an improvement in the underlying indicator. So this one could be considered a bullish near-term divergence signal in addition to a rare stock that has higher highs and higher lows and is continuing in a bullish trend within a bearish market. Okay, so that's what I had for you here this evening. Again, appreciate you guys checking out these videos. if you got value out of the video, and if you want to say thanks for my time, simply click like for me there on Twitter. As long as we're up and over 100 likes again on Thursday when I do the video, I'll plan on doing a full-length video including a trade application example like this one I just showed you here. If we're under 100 likes, then I'll just plan on doing a quick little 15-minute video just on the indices themselves with no trade. So we'll leave it up to you. If you're getting a little bit sick of these longer form videos, I certainly understand that as well. So no need to click like if that is the case. Otherwise, if you do want more of my time and not less of it, then all you have to do is take 5 seconds out of your day to click like for me there on Twitter. Thank you so much for that. I'll see many of you tomorrow morning in my factor-based swing trading class. David will be back with you tomorrow night in this particular video, and then I will likely see you on Thursday in this video as well. Until then, I want to wish you all the best of success with your trades and your investments. Goodbye for now.